students to the massive open online course on regulatory institutions in India. Here again, I am going to do a two-part module on regulatory institutions in India. So today is the first part. The basic objective of this module would be to explain the concept of regulatory bodies and also to outline the timeline of the existence of regulatory bodies or regulations like the Hilton Young Commission, the Narasimham Committees 1 and 2, and also to understand in detail the working and the functioning of the Securities Exchange Board of India, in short, the SEBI. Now, what are financial regulatory bodies in India? Financial regulators are government or non-governmental organizations who are responsible for overseeing and regulating the financial markets and institutions to ensure their stability, integrity, and fair operation. They do establish and enforce rules and regulations that governs the various aspects of the financial sector. In India, the history of financial regulation is marked by the establishment of various committees and regulatory bodies that have shaped the country's financial sector. And so, in this module, we would like to give you a precise or a brief description of some key milestones and committees which are related to financial regulations in India. And so, my first in line is the Hilton Young Commission of 1926. This is basically the first regulatory body you can say of modern India. Now, we all know that the autonomy of the central bank, that is the RBI, this has been a recurring theme in the literature on monetary policy and the central banks. However, the exact relationship between a central bank and the government in any country is also determined by the historical circumstances as well as the practices that have developed over time. Long before Hilton Young Commission's recommendation in 1926 about the creation of a central bank, the Chamberlain Commission in 1914 included in its report a comprehensive memorandum by the famous economist John Maynard Keynes, who was one of the members of the Chamberlain Commission, who proposed that the three presidency banks in India must be amalgamated into one central bank, and that is going to be called the Imperial Bank of India, which would undertake the functions which are now generally associated with the central bank. And so, in keeping with the memorandum of the Commission, the Imperial Bank Act was passed in 1920 on the general line of the memorandum of Keynes. The seed for the central bank or a central banking institution for the Indian economy was thus planted at that very moment. However, the underlying intention that the Imperial Bank should gradually take over the functioning of the currency and the other central bank functions, that could not be fulfilled, mainly because the Imperial Bank was dominated more by its commercial functions. So it was, it's really good to note that the Hilton Young Commission took the line that an entirely separate institution should be created. And that institution would be called the Reserve Bank of India, or the RBI. And the Imperial Bank should be more completely commercialized and should merely operate as an agent of the RBI for the routine management of the accounts of the government. So, the Hilton Young Commission was appointed to recommend reforms in India's currency and banking system. The Royal Commission on Indian Currency and Finance. This was precisely the name of the report that was released by the Hilton Young Commission. It recommended the establishment of a central bank which was to be called the Reserve Bank of India. It led to the passing of the Reserve Bank of India Act in 1934, which established the Reserve Bank of India as the central banking institution. The Hilton Young Commission advocated also some sort of private shareholding, and the shareholders of the Imperial Bank got the first opportunity to subscribe to the capital stock of the new bank. The government, however, did not accept the suggestion and implicitly advocated a state bank for this matter. However, socio-political issues did extend the debate. Next, we come to the Narasimham Committee 1. Now, I was talking about the Hilton Young Commission that was way back even before India had gained independence in 1926. Now I jump to another phase of the Indian economy. And in this phase, what do we generally see? We see that it is an economy where the bells of liberalization, privatization, and globalization has already been sounded. That means I'm talking about the time period 1991. And it was soon realized that once government has started off with the reforms of the real sector, these reforms will not be able to reach its logical culmination till some other supplementary reforms were also carried out in the banking and the financial sector. And it was this realization that there is an interdependence between the real sector and the financial sector paved the way for the banking and the financial sector reforms in India. As far as the banking sector reforms in India are concerned, they have largely followed the roadmap which has been laid down by two very powerful, high-powered committees which were appointed by the Monetary Authority under the chairmanship of the former governor of RBI, M. Narasimham, in 1991 and 1998. So basically, students, you should keep in mind that there are two Narasimham Committee reports. The first one, Narasimham Committee Report 1, this committee was formed in 1991, while the second one, that is Narasimham Committee 2, was formed in 1998. And so we have these two high-powered committee which would try to steer out the Indian economy's financial sector crisis. Now, both these two committees, the Narasimham Committee 1 and 2, they aimed at making Indian banks more healthy, more effective, and more competitive. Towards this end, it was envisaged that the banks in India should follow the best banking practices at the international levels as suggested by the Basel I norms set by the Basel Committee on Banking Supervision. More specifically, in line with the basic spirit of the prudential regulation of the financial sector, the Narasimham committees progressively introduced risk-based capital adequacy norms along with income recognition, asset classification, and provisioning norms for the Indian banks. The Asset Reconstruction Fund, ARF, was set up so as to take over the stressed assets from the banks, and this was also very much a part of the reforms agenda for banking and financial sector of the Indian economy. Let us now focus our attention more on the Narasimham Committee 1. Now, in order to give some sort of market orientation to the banking sector, the Narasimham Committee 1 recommended that there shall be no more nationalization of any commercial bank and even allowed public sector banks to raise 49% of their equity in the capital market, along with advocating the setting up of private sector banks. So as soon as the Indian economy opened up in 1991, we found quite a number of private sector banks coming in. Side by side, it was also suggested that there shall be no more expansion of any bank branch in hitherto backward areas if it was found that setting up of such branches in these rural sectors was not commercially viable. Likewise, the Narasimham Committee 1 also professed that in order to increase the commercial profitability of the banks in India, the statutory preemption of public funds through the statutory liquidity ratio, that is SLR, and through the statutory cash reserve ratio, that is CRR, shall be cut down, and also the interest rates shall also be deregulated. In fact, it was essentially on the advice of Narasimham Committee 1 recommendations that the monetary authority gradually moved from direct instruments to indirect instruments of monetary control, as these indirect instruments were more compatible with market logic and they did not have any annulment of statutory compulsions in them. The acceptance and eventually the implementation of all the recommendations of the Narasimham Committee reports, Narasimham Committee 1 recommendations since 1992 really marked the beginning of the first generation of financial reforms in the reform phase of the Indian economy. After 1991, after a long 7 years of Narasimham Committee recommendations 1, comes the second generation of reforms of banking and financial sector. And this was started after the economy accepted the recommendations of Narasimham Committee 2, whose main thrust area was fiscal consolidation and convergence of traditional banking and non-banking services from the perspective of customer-oriented banking that eventually paved for the concept of quote-unquote universal banking in India. The Narasimham Committee 2 was governed by the basic philosophy that competition is a stern taskmaster and there is no room for laxity in its lexicon. So there is, you cannot afford any sort of laziness in this respect, any sort of laxity in the respect of financial regulation. So according to the recommendations of Narasimham Committee 2, they insisted on strong legal and technological reforms with a view to further raising the efficiency of Indian banks and making them globally more competitive. The most important regulatory body in the context of the Indian economy and its financial sector is obviously the SEBI, the Security Exchange Board of India. 1991, as I've already said, had witnessed a big push in terms of liberalization, privatization, and globalization in the Indian financial sector. Thereafter, an increase in the volume of business in the financial sector, that is the primary and the secondary securities market, was observed just after 1991. At the same time, the globalization of the Indian financial system made it vulnerable to various sorts of external shocks. We had the multi-crore securities scam rocking the Indian financial sector in 1992. All the above developments pressed the need for having a vigilant regulatory body. And the SEBI, the setting up of SEBI, was just a very timely response in that regard. The Securities and Exchange Board of India was established in its current incarnation in April 1992, following the passage of the Securities and Exchange Board of India Act by India's Parliament. It supplanted the controller of capital issues, which had regulated the securities market under the Capital Issues Control Act of 1947, passed just before India had gained its independence from the colonial rule. The SEBI headquarters is located in the business district at the Bandra Kurla campus in Mumbai. It also has its regional offices in the cities of New Delhi, Kolkata, Chennai, and Ahmedabad, and more than a dozen local offices in cities including Bangalore, Jaipur, Guwahati, Patna, Kochi, and Chandigarh. The Securities and Exchange Board of India is the most important regulator of the securities market in India. It is a counterpart of the Securities and Exchange Commission. In my earlier module, I had explained the Securities and Exchange Commission of the US. SEBI is just a counterpart of that US body in India. The stated objective of SEBI is as follows. Quote, to protect the interest of the investors in securities and to promote the development of and to regulate the securities market and for matters connected therewith or incidental thereto, unquote. So this is basically the stated objective of SEBI. Now what is the structure of SEBI? The board of SEBI usually consists of 9 members and more than 25 departments, some of them being the Corporation Finance Department, the Investment Management Department, etc. As for the board members, the central government of India appoints one chairman of the board, one member board is appointed by the Reserve Bank of India, 2 members of the board are from the Union Ministry of Finance, and the central government of India again elects 5 members to the board. So overall there are 9 members. Now, if we again look at the board of directors, the composition of the board of directors, we find that the SEBI's senior management is made up of a board of directors who are elected by several government agencies. The Union Government of India nominates the chairman of SEBI. The chairman of SEBI is nominated by the Government of India. 2 officers is nominated from the Ministry of Finance of the Union. 1 member will be appointed from the RBI. And 5 members again will be appointed by the Union government. So SEBI is really a very, very important institution because it really fulfills the watchdog for all capital markets and seeks to create an atmosphere that allows the security market to operate smoothly and efficiently for financial market participants. It also plays a crucial role in the economy of India by protecting the investors' interest, monitoring how the intermediaries function, and prevent any sort of malpractices. Now, next, we would try to look at the various objectives and functions of SEBI. What are the various objectives of SEBI? Now, the main objectives of SEBI are as follows. 1, to protect the rights of the people who are motivated towards investing in stock markets and create a safe environment for them to invest money without any sort of worry in the world. 2nd, prevent any sort of malpractice and regulating the working of stock exchanges. This is a very important and another primary objective of SEBI. Thirdly, to develop and maintain a specified code of conduct to be followed by intermediaries like brokers, etc. Fourthly, to ensure the efficient functioning of the capital markets and also to maintain a balance between the legislated self-monitoring by the securities sector. Next, we come to a very important question like what are exactly the functions of SEBI? Now, those were the objectives that I have already underlined. So, we now come to the main functions of SEBI. SEBI has basically or primarily 3 main functions. Number 1 is its protective function, protecting the investors. Second is its regulatory function. And thirdly is its developmental function. And if we look at each of these 3 further, then we can understand them more in detail. Now, what are the protective functions of the SEBI? Monitoring any sort of rigging practices in regard to prices, which means malpractices with the aim of sudden or abnormal increase or decrease in the stock prices in the market, forcing people who had invested in facing the loss and backlash. Restricting insider trading. This is another very, very important function of SEBI. What does it mean? It basically refers to the fact that insiders like employees who are working within the company who have access to crucial sensitive information and are involved in purchasing and selling of securities and altering in this way the price of the securities. So these type of activities are totally monitored by SEBI. Forbidding any sort of unfair and deceptive trading of securities by coming up with laws and codes of conduct in the securities market. Expanding investors' understanding of strategies to evaluate investment opportunities better, and therefore organizes offline seminar and also online sessions to raise awareness about these important concepts. Now, next we come, these were all basically the protective function of SEBI. But SEBI also has a very important role to play in terms of its regulatory function. Now, the regulatory function is to set rules and regulations for the intermediation for the efficient functioning of the market. Now, a particular code of conduct is implemented on financial intermediaries like underwriters, brokers, etc. The working of mutual funds are deeply monitored by keeping a close eye on the business operations. SEBI does this. It looks over whenever another company is taking over another company, how the whole process is being monitored by SEBI. It oversees and keeps track of the merchant bankers, trustees, stockbrokers, and other stock exchange members. It performs all sorts of inspections and audits to monitor the functioning of the stock exchanges. So these, in short, are the regulatory functions of SEBI. Next, we come to the development function of SEBI, which refers to the steps undertaken to strengthen the security market by using the ever-growing, ever-innovating newest technologies of the countries. So it involves activities like providing training to all the intermediaries. It is also responsible for engaging with research and various other research-related work. It involves other functions like incorporating online trading through licensed brokers. It also promotes self-regulatory groups and focuses on fair trading with no sort of misconduct. Now, SEBI, has got the right or to issue guidelines in respect of information, disclosure, operational transparency, and investor protection. It can help in the development of financial institutions. It looks into the pricing of issues. It looks into bonus issues, preferential issues, financial instruments, firm allotments, and transfer of shares also amongst the promoters. Next, we come to the concept of the powers of SEBI. Now, what are the power of SEBI? SEBI has various powers. So my first power concentrated is power of seize and search. Now, under section 10, SEBI is empowered to search any premises or place where it believes that any books of accounts, documents, vouchers, computer disk or storage device used in connection with the security market is kept, and they can seize them whenever it is necessary. Section 11 of the Act gives them the power to issue search warrants for any place or premise occupied by a person reasonably suspected of having committed an offense which is punishable under the Act. So they don't need to go to a police station to do that. The SEBI itself has this power to do all these things empowered upon them. Then another very, very important power that SEBI exercises and has is the power of arrest. Under section 12, any officer of SEBI or any other police officer not lower in rank than that of assistant superintendent of police may arrest without warrant any person who has committed any offense that is punishable under the SEBI Act. Thirdly is power for service or attachment. Under section 14 of SEBI, any officer authorized by it in this behalf can serve a copy of order made by it on the concerned person through its officers and also attach their property pending disposal of any proceedings under the Act. SEBI has the power to appoint officials. In terms of Section 19, SEBI may appoint its officers, employees and others as deemed necessary for the discharge of function under the Act. It can also co-opt any officer of the government or law enforcement agency as an officer of SEBI. Fifthly, SEBI has got the power to make regulations. The board may, with the previous approval of the central government by notification in the official gazette, may make rules which are consistent with the Act for carrying out the purposes of the Act. These rules are called Securities and Exchange Board of India Futures Trading Regulations 2004. So SEBI had made this act. SEBI has also the power to grant sanctions. Under Section 21, SEBI may grant sanction or commence any proceedings before the appellate tribunal or it even by itself for sanctioning prosecution under the Act. It keeps a comprehensive record of all proceedings before it. SEBI has also the power to recover any sort of dues it has. Under Section 28, the board has been given the power to recover from any person any sum which he is liable to pay under this Act and any other sum payable by him under this Act or rules made thereunder. The board will file a suit for recovery in a civil court. The civil court will not have a jurisdiction to entertain any suit instituted for recovery of money due to SEBI without the previous sanction of SEBI. SEBI has the power of the central government. Under Section 31, the board has been given power and function as are exercisable by a civil court under the Code of Civil Procedure 1908 in respect of the following matters, namely, summoning and enforcing the attendance of any person, requiring discovery and production of any document, receiving evidence on affidavits, etc. Lastly, I would like to focus our attention more on the investor protection measures of SEBI because I feel this is the most important one. Now, according to the SEBI Act 1992, investor protection is what? It is protecting the interest of the investors in securities and promoting the development of and to regulate the securities market and for markets connected therewith or incidental thereto. I have already said this before. So generally, investors' protection is known as legislation to protect the small investors from unscrupulous investment brokers and advisors. There are ample stories which we know where numerous of people have lost their money in the share market because of these type of unscrupulous investors and brokers. So SEBI is for the common good. He tries to protect the investors from such things. Now, SEBI has given out various methods and measures to ensure investors' protection from time to time. Now, firstly is issuance of guidelines. SEBI has issued guidelines to companies who are bringing new issues into the market, even to mutual funds, to portfolio managers, merchant bankers, underwriters, lead managers, etc. And these guidelines are for bringing some amount of transparency in their operations and also for avoiding exploitation of investors by one way or the other. SEBI has also introduced a code of advertisements for public issues for ensuring fair and truthful disclosures. In order to reduce the cost of issue, the underwriting is made optional on certain terms. These steps are also taken for the protection of the investors. SEBI keeps watch on all intermediaries and see that they follow the guidelines in the right spirit. It also takes panel actions when the guidelines are not followed, and these steps gives protection to the investors. SEBI also comes up with various types of public interest advertisements. They issues these advertisement to enlighten the investors on the basic features of various instruments and minimum precautions they should take before choosing an instrument. The SEBI desires to create awareness amongst investors about their rights and how to think of any type of remedies about any problems that may arise. It has published some booklets for information and guidance of the investors. Now suppose some investors has complained to SEBI. How do SEBI deal with it? The investors can make complaints to SEBI, and if they face problems relating to their investment in industrial securities and financial assets. SEBI usually receives thousands of such complaints relating to non-receipts of refund orders, allotment letters, non-receipts of dividend or interest, and delays in the transfer of shares and debentures. SEBI at this point of time is also continuously trying to make efforts to solve such complaints through appropriate measures. But the most important, I believe, function of SEBI is the investors' education. SEBI is aware that investor education is important for his protection. If he is not aware, if the investor is not educated, whatever the SEBI does to protect the investor, it will not be helpful. So it encourages the formation of investor associations that will help to disseminate information through newsletters. SEBI generally brings out 2 monthly publications for the investors. One is the SEBI Market Review and the other is a SEBI newsletter. And these publications are for the education, guidance, and the protection of the investors. And SEBI will not be able to function properly if SEBI does not have any sort of good feedback system. So the investor surveys that SEBI does usually helps in their feedback. So SEBI conducts surveys in respect of investment and opportunities for the benefit of small investors. The findings of the survey that SEBI does are given wide publicity so as to provide proper guidance to investors regarding their investment decisions. SEBI also introduced the concept of stock invest. Now, what is stock invest? Stock invest basically is a new instrument. It is very useful while submitting application for shares. This new instrument introduced throughout the country through the cooperation of banks gives protection to the investors as they get interest on the application money till the shares are allotted to them. And obviously disclosure of companies, another very, very important thing in this regard. SEBI has introduced norms for disclosures of half-yearly unaudited result of the companies. It has also revised the format of prospectus to provide more information to the investors. It also insists that every share application form is accompanied by some sort of abridged prospectus. The provisions relating to disclosures are for the information and protection of small or average investors. And one more thing, SEBI has also gone to create an Investor Education and Protection Fund, IEPF. Now, to protect the interest of the investors in securities and to promote the development, to regulate the securities market, for all these things, this fund is called the Investor Education Protection Fund, which is IEPF. What are the objective of this fund? To educate investors about how the market is going to operate, to make investors educated enough so that they can analyze and they can take informed decisions, to educate investors also about the volatility of the stock market, to make investors realize their rights and various laws about investing, and also to promote research and surveys to spread knowledge amongst the investors. The next point that I would like to bring in front of you is that suppose there is an investor and an investor complains to SEBI. How will SEBI handle that issue? Now, SEBI has got a dedicated department. The name of that department is Office of Investor Assistance and Education, OIAE. They receive the investor grievances and they provide assistance to the investors by way of educating the investors. Investors who are generally not satisfied with the response given to their grievances can lodge their grievances to the SEBI. Who are not satisfied with the response to the grievances received from the stock exchanges or from the depositories. Grievances pertaining to stockbrokers and depository participants are taken up in the respective stock exchanges and depository for redressal and monitored by SEBI through periodic reports obtained from them. Grievances pertaining to other intermediaries are taken up with them directly for redressal and are continuously monitored by the SEBI. Grievances against listed companies are taken up with the respective listed company and are continuously monitored. The company is required to take respond in prescribed format, and the report is called Action Taken Report, ATR. Upon the receipt of the ATR, the status of grievances is updated. Where the response of the company is insufficient or inadequate, follow-up action is initiated. If the progress of redressal of the investor grievance by an entity is not satisfactory, appropriate enforcement action like adjudication, direction, prosecution, etc. can be carried out or initiated against such entity. The last part of this module deals with scores. What is scores? SCORES. It is SEBI Complaint Redressal System. So, scores is a formally grievance redressal system of SEBI. It is web-based, centralized grievance redressal system. And the most important feature of scores is it is web-enabled. It provides online access 24/7. Complaints and reminders can be lodged online at the website anywhere at any time. Then and there an email will be instantly generated acknowledging the receipt of the complaint and allotting a unique complaint registration number for future reference and tracking. The complaint will then be forwarded to the entity concerned. I told you about the ATR. The entity concerned will upload the ATR on the complaint. The SEBI will pursue the ATR and close the complaint if it is satisfied. So, at the end of this module, we learn about the various sort of regulations and regulatory bodies in vogue in India. Like we started with the Hilton Young Commission, and then we had the two very important regulations in the financial sector, that is the Narasimham Committee 1 and 2. And then we talked about the most important regulatory body in the financial sector in India, that is the Securities and Exchange Board of India, SEBI. We discussed its functions and all the various roles that SEBI performs, initiatives taken by SEBI in the Indian economy.